Since childhood, he heard the same message repeated in different voices, from family dinners to billboard ads. Renting is a waste. Owning a home is success. A house was presented as the ultimate proof of adulthood and the foundation of real wealth. Over time, this idea stopped sounding like advice and started feeling like a rule of life. By his late 20s, the pressure felt personal. Still renting meant he was behind. Friends were buying homes, posting photos of keys and empty living rooms, calling it an investment. Feeling ashamed and afraid of missing out, he stretched his finances to the limit and signed a mortgage that left almost no breathing room. At first, ownership felt like an achievement, but month after month, a huge payment left his account, and very little of it seemed to build real wealth. The belief that every mortgage payment was paying himself turned out to be far from the truth. Most of his housing costs were actually unrecoverable, money he would never see again. Mortgage interest consumed the majority of his early payments, going straight to the bank. Property taxes rose regularly, insurance premiums increased, and maintenance issues appeared at the worst possible times. He slowly realized that owning didn't mean living for free. It meant having several new landlords, the bank, the government, and the endless list of repair services, the roof, the plumbing, the heating system. Everything was now his financial responsibility. Then came the number that changed how he saw everything, the price-to-rent ratio. When he compared the cost of buying similar homes to the cost of renting them, the difference was shocking. Homes were selling for prices that would take decades of rent payments to match. He also began to understand the hidden cost of his down payment. The large sum of cash he had locked into the house could no longer be invested elsewhere. It sat trapped in walls and floors, producing no income and offering no flexibility. If that money had been invested in diversified assets, it could have grown over time while remaining accessible. Instead, all his wealth was tied to one building in one neighborhood, dependent on one local market. Mobility became another unexpected sacrifice. When a promising job opportunity appeared in another city, moving suddenly felt complicated and expensive. Selling a home meant fees, paperwork, uncertainty, and the risk of losing money if the market had dipped. Renting, he realized, would have offered flexibility. It would have allowed him to move quickly, take risks, and adapt to changing circumstances without being tied to a long-term financial anchor. There was also the emotional cost. Weekends disappeared into hardware stores and repair projects. Every strange sound in the house brought stress because every problem came with a bill. Ownership didn't just demand money, it demanded time and mental energy. Eventually, he stopped seeing a home as an automatic investment. It was a place to live, a lifestyle choice, not a guaranteed wealth-building machine. Whether it made financial sense depended entirely on price, location, and personal plans. True wealth, he realized, comes from owning assets that generate income and remain flexible, investments, businesses, skills. A primary residence can be part of life, but relying on it as the main financial strategy can be risky and limiting. In the end, the most important lesson was simple. Don't follow financial scripts blindly, run the numbers, understand the trade-offs, and choose the path that supports both your lifestyle and your long-term freedom.